Hello and welcome to the Global View on this Friday. Well, Treasury yields have surged again after Federal Reserve Chair Jerome Powell warned that more evidence of heat in the economy may prompt policymakers to lift rates further.
Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully.
He said additional evidence of persistently above trend growth or that tightness in the labour market is no longer easing could put further progress on inflation at risk and then therefore could warrant further tightening of monetary policy. He noted that the bond market is making the Fed's job easier.
Again, in principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case. Actually, I don't think it's the case. It doesn't seem to me that's where analysis leads you. Then sure, that's a tightening. That's exactly what we're trying to achieve.
Now, those comments pushed the 10-year US Treasury yield to a 16-year high, just touching 5%, with it having risen about 35 basis points this week alone. The 2-year yield at 5.17%. And the US dollar fell despite warnings from the Fed chair that the bank could raise interest rates again. The Aussie dollar trading at 63.3 US cents. Well, taking a look at what's going on X, Liz and Saunders, chief investment strategist at Charles Schwab, saying the yield on the benchmark 10-year note there hitting the 5% mark for the first time since July 2007. The benchmark yield having surged, as I mentioned, about 35 basis points this week as investors expect interest rates to remain higher for longer, a common refrain from the Federal Reserve officials who are fighting the highest inflation in the States since the early 80s. And we do see that curve flattening between the 2 and the 10, which is a sign, historically at least, that recession is ahead. Well, of course, we're also in the midst of earnings season in the States. Well, for a preview of some key tech stocks that are going to be reporting next week, I caught up with Angelo Zino from CFRA.
I think this is an extremely important earnings season, right? I mean, with so much uncertainty from a macro perspective out there, and especially, when we kind of think about, the performance in many of the kind of the non-tech sectors out there year to date, it's really kind of been a number of these big bellwethers that have really kind of been holding up the U.S. market very well. And, as we kind of start going into earnings season for big tech, I think all eyes are really going to be on October 24th, which is when both Microsoft and Alphabet report. We ironically think those are probably going to be the two most important earnings reports this season, and they happen to both report on the same day.
All right. Of course, all eyes on those Treasury yields at the moment. Given they're at elevated levels at this point, what sort of drag is that on growth going forward, do you think, more broadly?
I mean, ironically, when you kind of look at big tech, they've actually been viewed as a safe haven in this market, right? Because when you kind of think about the balance sheets for essentially all of these big tech companies, they're all sitting with hefty net cash positions. They're generating significant free cash flow. They don't need to tap the debt markets to invest in their companies, right, in terms of their businesses. So they can utilize that free cash flow towards growing the company. So ironically, they've actually been kind of a safe haven in this market amid a rising interest rate environment. So as far as kind of more the impact the interest rate has on the macro picture and the consumer out there, I think that's kind of the bigger question. And up until now, these companies have been able to kind of buck the trend. We do think the U.S. consumer remains very healthy in nature. So as far as this earnings season is concerned, at the very least, we don't think there's going to be much kind of disappointment as far as kind of the big tech names are concerned.
All right, well, Angelo, let's take a look at 4 of the big ones there. We might do it alphabetically, perhaps, and start with Alphabet itself. You've got a buy on this. What's your thesis?
Yeah. We have a buy recommendation, and our 12-month target price is $157. But really, kind of our thesis here is we expect the company to really beat all across the board. So in terms of their search business, we're looking for growth of about 6 to 8% here in Q3 and Q4. Would be an acceleration from what we saw in Q2 as in terms of the 5% growth rate, as well as a low single-digit growth rate we saw in Q1. So continue to see just easier comps that they're going to be lapping, as well as kind of an improving digital ad landscape out there. Not to mention some of the AI initiatives out there should help. So you also kind of look at their other businesses. Cloud, of course, continues to be rock solid. We see a high 20% growth rate from that business, and again, the work they're doing on the AI side of things, as well as kind of the momentum they're seeing in workspace, will continue to drive that business. And then YouTube, of course, I mean, it was a business that they recently acquired, the NFL Sunday Ticket package, and we do think they saw strong momentum in Q3, obviously because of the start of the NFL season and the easy comps from a year ago in that business as well. So we do think they returned to double-digit growth here in Q3 and Q4. So as far as kind of their three core business lines are concerned, we see a pretty good trajectory here, exiting 2023 as well as into 2024.
Angelo, you did mention those AI initiatives from Alphabet. In particular, it's sort of seen as perhaps lagging, given what we've seen from Microsoft in terms of its Google search engine.
Well, I mean, yes and no. I mean, on the search side of things, we actually do think Alphabet's going to end up kind of winning the race on that side of things. They did lag it initially, but they're kind of investing heavily in kind of their next generation large language model, that being Gemini, as well as something called their search generative experience. Eventually, that's going to kind of really drive the momentum on the search side of things. We think that's going to support higher return on investments out there for advertisers, and ultimately lead to higher revenue within that search business. But as far as kind of the Bing debate versus Google, we do think ultimately maybe Google loses a couple of points of share over time, but nonetheless, it will continue to be the dominant player out there.
Okay, let's move to Apple. I see you have adjusted your estimates for Apple. Why is that?
Yeah, I mean, as far as Apple is concerned, we did tweak our estimates a bit, but as far as kind of, what Apple is all about, they are a very stable company out there. I don't think the growth momentum out there, when you kind of look, over the next 12 to 15 months, is as attractive as some of the other large cap tech companies out there. I do think all eyes right now are going to be on the iPhone 15 and the commentary specifically out in China, because there is some uncertainty going on there. But at the end of the day, this is a company that has a number of drivers that they can move in terms of the needle on the earnings line. So if they were to happen to disappoint on that side of things, we do think they can make up for it in other areas. But most important is going to continue to be the services business, which we think is actually accelerating. We think they're going to return to 10% year-over-year growth here in the September and December quarter. And I think also, the ongoing buybacks out there and the growth in the installed base also extremely important to the Apple story. So I think as far as the iPhone 15 cycle is concerned, probably grows in line with the rest of the smartphone market, whereas the last 3 years they were more of a share taker.
How resilient are its sales, particularly given the pressure on consumer spending at the moment?
Well, it's interesting. You actually look over the last 12 months, and and it all depends, right? So you look over the last 12 months, and they've actually seen declines in 80% of their business, right? You kind of talk about iPhones. They've seen declines on the iPhone side of things, especially on the unit side of things in the US. You kind of look at Macs. Macs are down north of 25% over the last 12 months. You look at iPads, also declining, as well as the wearables business, because of the kind of the post-pandemic blues out there. But despite all those declines, we did continue to see growth on the services side of things, and the earnings number is only going to decline less than 1%, despite declines across 80% of their business. So as far as the bottom line is concerned, again, they're doing a ton of stuff in terms of improving the margin structure, especially on the hardware side of things there. So they've been able to hold up the earnings trajectory there. But as far as the top line is concerned, they are now going to start lapping some easy comps due to the declines that we've seen over the last year. We do expect a new M3 chip on the Mac side of things. So you're going to be lapping the 25% declines. We do expect to see growth on the Mac side of things over the next 12 months. So they are definitely a consumer-driven company. 90% of their revenue is tied to the consumer. But at the end of the day, given that they operate at the high end of the consumer market, they have historically been a lot more resilient than other smartphone makers.
Angelo, let's move to Meta Platforms. You have slightly increased your estimates. Why is that?
Yeah, I mean, as far as Meta is concerned, we were probably a little bit too bearish on that side of things, kind of going into the quarter, just being more conservative in nature. But when you kind of look at what this company has done in terms of retaking share on the digital ad side of things, it's been great. And we've underestimated really kind of the momentum that they're seeing on that side of things. Again, AI is playing a big part in all of this. They're investing heavily in AR. It's helping to improve their rankings, their recommendations. And you're seeing some really good momentum in areas like Reels, where it was only a $3 billion business last fall and now north of a $10 billion business. So you kind of look at where they're seeing strength out there, and they're clearly being a share taker. And it actually helps that we're actually seeing kind of a fairly kind of slowdown in the broader economy, because there are actually more advertisers out there that are shifting towards the big two players out there, that being Meta and Alphabet on the ad side of things, because they know the return on investment is going to be higher from those companies. So we've definitely seen a shift in terms of the ad spend towards the high end of the market.
All right, Angelo, let's round it out with Microsoft. We spoke about what's going on in the AI space there with Alphabet. How's that panning out for Microsoft, and also in terms of that migration to the cloud?
Yeah, and you kind of just hit on probably the two most important items to look at for Microsoft this earnings season. I mean, it's our highest conviction call long term. We do have a strong buy recommendation. Our 12-month target price is $407. But when you kind of look at really what to look out for, it's Azure. We're looking for a stable growth in terms of from the last quarter. So we're looking at about 27% growth on a constant currency basis, which is pretty much what they reported in the June quarter. So the deceleration we've kind of seen over the last 6 to 7 quarters, it looks like it's starting to stabilize now, because we are starting to see more contribution on the AI side of things within Azure. And we think that momentum is going to pick up in the December quarter, more importantly in the March and June quarters next year. And then, again, as far as AI is concerned, Microsoft is ramping up and launching Copilot on 365 in early November. And I think guidance is going to be extremely important for Microsoft, because we kind of want to see what type of indication they give as far as kind of as far as Copilot is concerned on 365. It's only going to be 2 months in the December quarter, so you're going to see, again, more momentum as you go through calendar 2024. So it won't necessarily be a hockey stick kind of play like we saw out of NVIDIA this year, but we do see incremental improvement on the AI side of things over the next 12 to 18 months for Microsoft.
Angelo Zino from CFRA. That is the Global View. Stay with us. The Open is just a second or two away.